Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler here talking about money and investing. Educating because nobody else seems to be doing it. Or very few people. The voices that you hear the most are people that are actually educating on things they want you to know so that you'll buy what they're selling. And that is not the way we work around here. Because I think the educated investor just does not get pulled astray. And there are all kinds of ways to get pulled astray. And number one, I'm going to start with, a lot of times I'll talk about the news of the day, things that are being talked about in the media. And today is no different. There was an article that I wanted to talk about here that was in Market Watch. And it was Beyond the S&P 500, How to Supercharge Your Diversification. Something we talk about a lot. You get a lot of lip service in the finance industry of diversifying your portfolio. Don't put all your eggs in one basket. Especially when you're dealing with times of calamity. A lot of times what our desire is to go away from diversification. I want to go towards safety. And when I go towards safety, like fixed income investments and things that are, annuities and things that I think are safe, I'm actually increasing risk. Because you think about it, we actually live in a world where currencies are not tied to any kind of a commodity anymore. There are all kinds of reasons for that I won't get into. But you have fiat currencies. In other words, it is not backed by anything. So therefore, what happens is you're depending upon the currency actually maintaining value. And we call that inflation when it doesn't. And that is, of course, a big problem with those types of investments. Is protection against inflation non-existent? Historically, we look at it. And, it can be a huge problem. Well, so what we do is we say, well, maybe I shouldn't do that. And I look at this as how do we get some semblance of security in our lives? It's just spread things out like crazy. Like think about your career. Or think about, let's say whatever you do for a living. What if all of a sudden what you do for a living becomes obsolete? Maybe you do something that is really in demand, but, what if it all of a sudden becomes obsolete? What if you're that person that makes horse, buggy whips or something like that? Or you're involved in something that is being supplanted by something else. And then I've got, there are all kinds of articles about how that's happening right now with AI and so on and so forth. But, just think about it. What do we do to protect ourselves from that eventuality? Well, what we do is we make sure that we're constantly learning, constantly reinventing ourselves, constantly picking up new skills, constantly doing something, anything to make sure that we don't become, a statistic and that we're not all of a sudden no longer needed in the economy. And that is something that, changes all the time. So look at the jobs and the careers of the 70s. The careers of the 80s and the 90s and how things have changed over the years. We've had to keep up. Well, you think about it with diversification, with investing, you don't know what's going to be happening out there. What are going to be the new technologies? What are going to be the new things that come along? What are the changes in the economic marketplace? What are the geopolitical changes that are going to happen? And how is that going to affect markets? Diversification is absolutely it's just critical. So one of the things that we talk about as a basic tenet of investing, and a lot of people think they're way more diversified than they are because they own a total stock market fund or something like that. And they go, I own the total stock market, until you explain to them that they almost own nothing in small companies in those portfolios because of the way those portfolios are weighted. They overweight big companies. And that goes with our biases. When we talk about how people end up getting taken down the wrong path, it's our biases that actually drive so much of our behavior. I'm familiar with certain things. Certain things have done better in the recent past history, and I'm driven by that. People are driven by thinking that they're more expert than they are because maybe they're really good in their field. They think all of us, oh, well, I must be, I'm really great at this. I'm really smart. That means I can do anything, and that investing is easy for me as well. Some of the worst investing mistakes have been made historically by some of the smartest people going, so that's just not true. So this article is talking about beyond the S&P 500, which I think is smart because right now the S&P has been on a run. Those are large 500 largest companies in the United States. It has been on a run. And I like a few things about this article, a few things I disagree with, but I'll point that out because that's part of what I do here is point out things that are being taught that aren't necessarily so. Now, it talks about beyond the S&P 500. Well, what's beyond the S&P 500? What's the first thing that they bring up? Well, they bring up bonds. Now, there is another article someplace else talking about how the 60-40 portfolio has just failed miserably. And I would agree because the way most people implement that, 60% stocks, 40% bonds, is just backwards. They own types of bonds that were longer bonds in these 60-40 portfolios. In other words, it's going to be a long time before they mature. You lend money, let's say to a company or to a government, and you're not going to get your money actually back for maybe 10, 15, 20 years, 30 years. That's a long bond. And what happens is that in the interim between when you lend the money and you get the money back, you're going to get interest payments. Well, if interest rates go up, then all of a sudden those bonds become worth less and less and less and less. And then all of a sudden, when interest rates go up and causing corporate expenses to go up because corporations pay interest on debt, now all of a sudden your stocks go down and your bonds go down together. So yeah, the way that most people did it, when you look at it, that's why you see articles like that 60-40 doesn't work anymore. And no, it doesn't if you implement it that way. And I laugh because it's like, this is stuff I've talked about for 20 years and the academic research has been out on it for a long, long time. 22 years now, I guess we're up to here. But the academic research has been out, but it gets ignored. I was talking to a friend of mine the other day and we got into talking about, how frustrated he was. And I laughed. I was like, I feel your pain. Because he says more people search for black holes than they do, any of the research on like modern portfolio theory or multi-factor or, any of the academic research that they just don't realize what a big deal it is. So the first thing he says, the most reliable thing he says here is to own bonds in addition to equities. And I always tell people, and I agree, that's what I always tell people, this is the first thing that we look at when we put together a portfolio. What's the stock versus bond mix? That's number one. And the reason being is that stocks and bonds historically don't tend to move with each other, especially when you're looking at, I don't like to go the long ones because they can, as I just described, they can move a lot together and really decimate you because all of a sudden they both move down and you're trying to draw an income and you're going, well, which one do I sell low? I've heard that the golden rule of investing is buy low, sell high, and now I have to sell low. Which one? And that's why we want shorter and high grade types of bonds in the portfolio, as I've talked about many times here. Because I want to have something that I can draw income from to buy time for, because historically equities always recover. I mean, you look at it, it's up and down. It's just normal that they go back and forth like that. But what people do is they go, let's just have this big repository of fixed income investments and, let's do the bucket approach. Let's draw from that until it's depleted and then we'll pull from equities. And I go, no, that makes no sense. And that's something I've taught elsewhere. It makes no sense because what you're doing is you're depleting it. And then once you've depleted it, what if stocks are down in that year? You're sunk, man. You are done. And now all of a sudden, what if the inflation has kicked up and all of a sudden your bonds, your interest rates have gone up and your bonds have dropped down in value and you're doing that, you're selling that into a low. There's a lot of reasons that just doesn't make sense, but I won't get into right here. But that's the first thing, though, the bonds in addition to stocks. And it says now when your overall risk is under control, you're likely to get the latest or the greatest long-term benefit from diversifying your equities. And this is something I don't see enough. I hear people talk about equity stocks and they talk about bonds, but they don't talk about types of equities. And I think that's a huge, huge mistake. Now, it talks about, well, what if the stocks are pretty similar? Having more of them may not help much. And I think that is a really good point. This is true. Owning all 500 stocks in the S&P 500 essentially eliminates the chance that any single corporate disaster will take you down. However, the index is heavily weighted to stocks of giant companies, as I've said many times on the show, nailing it in this MarketWatch article. Now, it says, however, the index is heavily weighted, and because of that, they mostly tend to move up and down together. And you can go, as I've talked about here on the show before, you can go 20 years pretty much, or, like the recent period where we went like 12, 13 years with no return, negative returns after inflation. Now he says, well, how do you do that? Well, you can diversify amongst groups of stocks. And then he says, don't recommend sector funds. Again, nailed it. Yes, sector funds. Too often people, they'll go, oh, tech is really hot right now. I just saw there was an email I got. And it was they set up this tech fund or these tech stocks with insurance on them. And I'm like going, well, okay, now what's happened? You've taken a certain type of stock with a potential return that might be high in some periods of time. And you basically watered it down by insuring it, because now what will happen is the rate of return, when you take away risk, you take away return. I mean, it's just the way it works. It's like when you have these options trades and stuff like that, and you have, futures and things like that. You're actually, or, with the annuities, with the, guaranteed, you can't lose and those types of things. They're using options type things to do that, to guarantee your downside. They have municipal bonds that are insured. Well, the higher expected return of any municipal, well, I don't like municipal bonds, but, I can't remember the last time I've ever recommended using that in somebody's investment portfolio, because of, again, what's the purpose of my bonds is to protect against risk. And then with the municipalities, you end up with risk. And I've talked about that before too. I won't go there right now. But anyway, so what happens is that with these options contracts and insurance, you're dragging down return because you have an expense that you have incurred to do that. There was a guy from a big investment platform that a lot of people, there are all kinds of commercials from this platform saying, hey, you can do your trades here, you can do them more cheaply, blah, 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 and all the beautiful things. And he was being interviewed, and he said, they said, what's going on right now? He says, well, we're not making as much money on stock trades, and you're not doing as much stock trading right now. And I'm going, yeah, because people are getting killed doing it, right? And they're, since they've been bitten so bad, they're not doing it anymore. He said, well, what are they doing? Options. I says, well, which one do you make more money on? He goes, options. We make a lot more money on that. So, Wall Street will do whatever you want, they will give you. They're just big enablers. It's like the parent that wants to be a really good friend to their child and just lets them do whatever they want, doesn't give them any kind of boundaries whatsoever. And the kid goes wayward and everything falls apart and they wonder what happened. Well, that's the same thing. You have this enabling going on Wall Street, and then people end up losing, and then they go, well, what happened? Maybe we just let you do whatever you wanted to do, and you shot yourself in the foot, and we made a bunch of money? It could be. So anyway, so he talks about in here, diversifying across asset classes. Well, gee, where have you heard that before? That's what I talk about all the time, diversifying across asset classes. And using the example here, they use small value, large value, those asset categories. Notice something missing from that. Something that's always missing when I teach is mid-caps. Why? Because you have this something called the goalpost effect, where you find that your greatest diversification are in companies that are more different from each other. Medium-sized companies are more similar to other areas. Why is this so important? Again, when I'm taking income in retirement, if I have something that's going down, I don't want to sell into the downturn. I don't want to keep selling at lower and lower prices because when it recovers, I don't have any shares left. That's the problem you run into. So they have these asset classes that they talk about. And it says, sometimes what happens with the S&P 500, he says, look back to history. Going back to 1928, each of these 4 asset classes, along with the results of combining all 4 in one, the 4-part combination, they have in a chart, they're showing what happens. It's if you believe the S&P is all you need, look at the chart and notice how many times that you end up in the bottom if you only have large U.S. stocks. It's a lot of times. And sometimes these years continued and continued. And you're sitting there going, when is this thing going to recover? And then you finally give up, and then it recovers after you give up, right? Isn't that classic? So what happens is that you look at, and they show all these different periods all the way through history that I've talked about before, so I won't, belabor that. But a lot of time in the last 100 years, you've seen where these downturns in the S&P goes on and on and on and on. And what happens is that in the period shown, they showed that the return to the S&P switched 34 times from positive to negative. I mean, it's a lot. That's not a recipe for peace of mind. And I think that's a really, really good point. And it says, well, what can we do about this? Well, one of the things that they talk about doing in this article is, each of these asset classes can be. Now, I would make sure that I have international too. If you look at international stocks right now, as I speak here, international is selling for way, way lower than U.S. for every dollar of earnings and for every dollar of book value for the assets. And it's because, that's been out of favor for a while. So, do you go, it's been out of favor for a while. I'll just not, I'm just not going to own any of that. And you go, well, you know what? U.S. large was out of favor up till about 8-9 years ago. And then all of a sudden, it did better than everything else. Does it make sense that now, after it's done so well for so long, that we just load up on it? Well, most people are loaded up on it, and they don't even realize they're loaded up on it. They don't realize that target date funds are primarily that asset category. They just don't even realize it because they don't even know what they're looking at. They don't even know what they've got. So he talks about in here, he talks about indexing the portfolio. And, the thing is, you can large U.S. stocks, you can buy an index fund for that. Small U.S. stocks, you can buy an index for that. Well, here's the problem with that. Dissimilar price movement. Like, for example, if you look at last year, the Russell 2000 went down over 20%. If you look at the asset category, yes, it was down, but it was down a lot less, 12, which is, you look at that 8% spread. That's a pretty big deal. And then you look at small companies like small value, the index, the Russell 2000 value index would be a small cap index. And that's what index funds would actually be looking at. A lot of index funds are going to actually mirror that. Well, it went down almost 15%. Whereas actually the asset category, small value, as I would own it, actually being more true to the asset category, down 3%. That's a big, big difference. Now, when in an up year, like the year before, where you had, let's say, small stocks, the Russell 2000 went up about 14%, just over 14%. Well, small caps, as I would define that, would be not cap weighting, not capitalization weighting it like an index fund does, up over 30%, 33% for microcaps. Well, that's a pretty big difference, up 14 versus up 33. So you look at that and go, wow, that can be a big, big, big difference. Small value stocks up 28. That the asset category, as I would hold it, up over 39. So what is the difference? Way beyond what I can get in this segment, but a couple of things. I'll give you a couple of things. Number one, not doing strict capitalization weighting based on the size of the company, making sure that the portfolio doesn't fluctuate because index funds are reconstituted every so often, usually about once a year. So what happens is that those indexes will look like a small cap index for a little while until it drifts. And then it will drift for an entire year, and will become more mid-cappy many times, medium-sized companies. And then you'll have how the portfolio is traded. You'll have the criteria for what we determine as value versus growth. So a lot of reasons that indexing is not a solution that I recommend. But overall, I give... that's a pretty good grade for an article like that. Beyond the S&P 500, how to supercharge your diversification. I think it's good in general what it teaches. Thanks for tuning in to the Investor Coaching Podcast. Now, you may be one of these people that's been listening and realizing, wow, investing, there's a lot more to it than meets the eye, and financial planning, tax laws constantly changing, and recognizing that maybe you might need some help in this area, but you don't want just anybody to help you out. So we have 10 offices in the Middle Tennessee area, and everything that we do is fee only. We align our interests with your interests. So you can get an initial 15-minute phone call with any one of our offices just by going to paulwinkler.com/call. That's it. Every one of the offices is run by somebody with 20 plus years experience. They're all degreed planners. They all have academic backgrounds in investing, and you can get the help that you need. So if you want to set up a complimentary phone consultation, just go to paulwinkler.com/call. And we look forward to seeing you soon. Right now, we're looking at a really interesting scenario regarding how, if we look at companies, and companies of course have lots of different areas of expense. One of them would be cost of goods sold. They have to buy parts and things like that, and to make whatever they make. They have infrastructure costs. Maybe they have to, maybe it's intellectual capital that they have to buy, or whatever, software. So you got your costs, you got your operating expenses, your lights, your heat and air, and then of course you have telephone and communications and computers, and you have your employee costs are going to be a big part of that. And one of the things that's been happening is we've had these demographic changes. And I've talked about this before, where you have certain countries around the world, Japan, France, and Germany, you have an aging of populations, and not necessarily we're seeing a lot of replacement of those populations through births for all kinds of reasons. That's not my kind of show, so I'm not getting into that right now. But there are things going on where all of a sudden now we're not seeing the growth in the population. And of course, we need employees. Well, what's happening, according to the Wall Street Journal, I just wasn't in the mood to work, was the title of this article. And it was American Employees Reinvent the Sick Day. So they're saying that the bar for taking a sick day is getting lower, and some bosses say that it's a problem. They're finding that U.S. workers have long viewed an unwillingness to take sick days as a badge of honor. Laurel workers care much. That's a laurel workers care much less about these days. Number of sick days Americans take annually has soared since the pandemic. Employee payroll data show. So now we got lower birth rates, and now we got more people taking sick days. That'll probably start to change in a little bit. But you think about it. So what is a company to do when this kind of change in behavior takes place? And you go, well, what's going on? I mean, this guy, he's taking a picture with his son, and they're off at a football game on his sick day. Well, he was too sick to go into work, but he wasn't too sick to go and take a selfie at a football game. And you go, whoa, okay. And, they said the younger generations are in front. Younger workers used to follow the example of their older peers and come in even when under the weather. And what they're finding, that is changing. And I think that there was another article in the same Wall Street Journal that explains what happens when companies do these kind of things. And it was entitled, Amazon Introducing Warehouse Overhaul with Robotics to Speed Deliveries. And I think that's what we're going to start to see more and more. They have looked at, we've all been talking about robotics for many, many years, right? Well, now what's happening is you have AI-equipped sortation machines, robotic arms. So now they're starting to take the intellectual type of duties that employees are engaging in or have engaged in. And that's what I've talked about here on the show before, is that, you look at the Industrial Revolution, that was taking physical labor and replacing it with mechanized labor. And now with AI, we're starting to see intellectual labor being mechanized. Because companies are going to figure out some way to do this. And it is always a question of which costs more. Does the employee cost more? Or does the machine? Because machines are expensive. Which one is more expensive? And what is happening is we're starting to look at that and go, well, and in some cases, if we start to lose the work ethic, that is going to be what ends up happening. It's either that or do without. And then all of a sudden, things become more expensive because they become more expensive to produce. And then all of a sudden, people regain their work ethic back. Because if I want anything, I better work. And of course, that changes the pressure on, and this is something Alan Greenspan talked about 20 plus years ago, talked about immigration and how to do it more smartly. We don't just let anybody into the country, but we look for types of people that we need and that we want and that will adapt to our way of life and so on and so forth. And that's the type of person that you let into a country, because reality of it is, I think I talked about a few weeks ago, it's like a 1.3 million person increase in the population in the United States in the last calendar year. And 1 million of it was immigration, illegal, legal. I don't know. They didn't give the breakdown on that. But that's a pretty small growth in population from birth. And so what happens is, if we're not going to have that growth in the population from that source, we're going to have to get it from another source. But what has always happened and what continues to happen is the finding ways to replace labor and mechanizing it if we don't have it. Why am I talking about this? Because this is why I like owning companies. Companies will adapt and they will do whatever they've got to do to get to profitability. And that is a perfect example of how they do just that. They will figure out some way, if it's going to be reducing expenses. If we can increase sales someplace, yeah, great, we're going to increase sales someplace, but we're going to reduce expenses if we can't do that. That is why stock markets, historically, you look at it during recessions. You look at it most of the time during recessions. Even if you invest at the beginning of a recession, stock markets typically go up more than they go down, even in recessions, because you have the ability to do that to increase profitability, even in a down economic time. And that's just another good example of how that happens. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.